This is, don't make any mistake. This is a financial tool. This is an investment strategy. We use different types of programs: home equity line of credit, index universal life, whole life, participating whole life, sweeps programs. We use all kinds of different tools to create an infinite bank, private bank, or in this case, a debt-free life bank. But in the end, there's one, when we look at this from an investment perspective, that is superior to the others. And that is actually our tax-free investment program called the Debt-Free Life Program. And the reason why it's superior is because it's tax-free. If you simply take a look at taking a same amount of investment, say $10,000, and you put it into a taxed solution, like putting money in a savings account, right? You're paying tax on the money before you use it, before you put it in your retirement program, but the growth is very, very slow. If you take it into another level, let's say you put it in a 401k or a 403 or any other IRA type programs, you're deferring the taxes. You're going to have growth. You'll have higher potential growth than what you're going to get in a savings account. But in the end, you're growing your tax exposure at the same rate that you're growing your wealth. And if you think that taxes are going up, then hopefully you realize that means that the taxes associated with the tax brackets are going up as well. And while your financial advisor or your water cooler financial planner that you spoke to at your job may be telling you, hey, look, just put money in your 401k, that may be the advice that they gave you, because then they'll say, because you'll be at a lower tax bracket later when you take it out. And that may be actually the case, that your tax bracket is lower, but it doesn't mean your taxes are going to be less. Taxes are going up. That means the taxes within those tax brackets are going up as well. So that's, unfortunately, if you talk to friends of yours, and I've got lots of people that are in this boat right now that took out 401ks and 403s and TSPs and FERS and KIOs and SEPs and all those other things. They took them out with the understanding that they would be able to take money later in life at a lesser interest rate, a lesser tax rate than they were taking it while they were earning it. And unfortunately, that's not the case. It's not going to be the case in many cases. So finally, if you look at the big column, the tax-free column, the reason why this program is tax-free is due to the nature of how we access the cash. This harkens back to a couple of IRS tax codes that we'll talk about a little bit later, but mainly and particularly IRS tax code 7702A, which says all money derived from life insurance is tax exempt, and it says money from a loan is tax exempt. So you can think about that for a second. When you bought your house and you borrowed $300,000 to buy your house, you did not have to pay income tax on the $300,000 that you borrowed, right? That's what this is about.